covered last week how a fiscal cliff deal would affect depreciation and payroll tax. This week, in our second of a three-part tax series with Tina Barrett, we'll look at changes to capital gains and the alternative minimum tax. Because of modifications, we'll see differences in individual income taxes as well.
So that was what got the most publicity by far, was what we were going to do with these income tax rates. And so basically, if your taxable income's under $400,000 single or $450 married filing joint, nothing's going to happen to your income tax rates. If you're going to be over that, then it's going to be 39.6%. And that's up from 35. So it's not a huge percentage difference, but it is a little bit more if your income's up there.
The capital gains, those are going to change as well. There are going to be different rates here. I'll let you explain the numbers.
Exactly.
You're much better than I am.
So for the last few years, we've had a 0% tax rate and a 15%. So if your income fell in that 10 or 15% bracket, you qualified for the 0% capital gains. If it was over that, it was a maximum of 15%. So the other thing that they did was if you were over that 400 or 450 mark, then they put it up to 20%. So again, if you're high income, your capital gains are going to go up a little bit to 20%. So we've got a little bit there. So, and capital gains is a big deal because we're not only talking about farmland sales, but dividends from corporations, from family corporations, which are also taxed as capital gains, now a permanent thing, which was going to expire, going to be stuck there. So, if we got a C corporation with income and your personal income's low, we still got that 0% tax rate.
We're essentially adding categories to it or brackets to it with this?
Yeah, so they basically, with what the fiscal cliff law did was add another bracket, another change. And for like the single individuals, it left the 35% bracket, like at $2,500 is all that 35% bracket covers now. So it's just added a whole nother level. But there is more complication to that. Of course, we can't not have more complication. Because the healthcare bill also added an additional tax that's coming into play in 2013. So you need the 400 and 450 is one mark, but that healthcare bill adds an additional tax if anybody's over more than $250,000.
And what's that tax?
So there's two actually. It's an additional Medicare tax, and they're taking a 3.8% tax on your unearned income, which might be interest. It's going to get those dividends. It could potentially get land sales. There's some issues there. If it's an active farmer, we're pretty sure that's not going to, but if you're a landlord, it could potentially be added to that. Rental income is another unearned income. All those are going to have an additional 3.8% tax on it. And then the other one is a 0.9%. It's a small one. Basically what it does is bring the Medicare portion of your self-employment taxes up to 3.8. And that's on any earned income, so your wages, your farm income, any other business income.
I want to step back for just a second here to the individual. They are going to pay an extra 2% a year. Is that correct on the income tax?
Okay, well that's a Social Security tax issue, so there's another change there, but your self-employment taxes are going to go from 13.3 back up to 15.3, and wage earners are going to see that 2% come through in greater withholdings in their tax bill, and that's an expiration of the payroll tax holiday. So lots of changes to the tax rates this year, and it's going to feel a little different. Lots of small changes, but they could add up.
The alternative minimum tax, it's becoming more progressive. Is that correct? They're going to make it permanent?
Right. So
or inflation permanent?
Yeah. So what happened is the alternative minimum tax is a law that came into play back in 1969, and because there was, I think, 155 taxpayers who had gotten out of paying taxes by taking legitimate deductions, and they wanted to make sure that didn't happen. And so, but what they didn't do was index that for inflation. So we've run into this problem similar to what we ran into with the estate tax, where inflation caught up with their number. And so for the last several years, we've having these 2-year patches for AMT. And they actually fixed it permanently this year and with a high index and indexed it for inflation. So it's still going to affect people, and high income people are still going to be faced with it, but it shouldn't affect that middle ground range that we were talking. It was going to start affecting people that were making about $50,000. So they were certainly not wanting it to affect them.
Once again, you're looking at the higher end.
Yes, yeah, it's going to be. And again, it's going to, anytime you take extra deductions such as state income taxes or a few of those kinds of things, that will kick it in. So.